you at Motilal Oswal AMC. Prateek, hi, very good morning. Want to
Good morning
first take the opportunity to wish you a very, very happy new year, happy 2026. Prateek,
to you and your viewers also.
likewise, sir, to your team, and thank you very much for your wishes. Pradeep, give us the sense. 2025, we've seen some underperformance, especially in broader markets. Give us a pulse of what you see play out in 2026 likely, who the outperformers could be of 2026.
Now, this is an interesting one. In 2025, if you see, in many ways, we decoupled from the world. You saw the world markets do quite well. We were amongst the poorest performers, while a lot of reforms and positive actions were taken in this country. Uh, Globally, themes like defense in Europe, renewables globally, electric vehicles, for example, new tech, worked very strongly. In India, these were parts which saw about of strong profit booking, let's say. So in many ways, we decoupled from the world, and I think a key reason for the same was very strong FPI selling that the country witnessed last year versus the year before. And hence, when one builds a scenario for the new year, it is important to see if we have it in us to be able to attract, again, FPIs. So to some extent, I think overall market makeup has improved. Beginning of last year, valuations were a concern. They are less of a concern now, while, obviously we are still not amongst the cheaper markets globally, but, relatively speaking, it's less of a concern now. Globally, bond yields are lower, and hopefully, if rupee stabilizes at a level, any level, it just has to stabilize. I think that would be a good combo to get some normalcy in the market. And then, one does believe that newer spaces which offers a strong quantum of continued growth could end up leading performance once again, like was the case in 2024.
Okay, quite interesting. Prateek, hi, morning. Happy New Year once again.
Happy New Year.
So, Prateek, I mean, we've been discussing that while the year gone by, you made that record high on the Nifty, that cheer or happiness wasn't there because individual portfolios, and especially mid and small cap concentrated portfolios, were still very much in the red. What's the likelihood that we will see a more broad-based earnings recovery, and that, of course, then will translate into, equity market performance as well from within mid and small caps?
So, why this has happened is one, to my mind, strong FPI selling pressure the last year. Second, that triggered in HNI retail selling on their own. I'm not talking funds on their own, which got the breadth of the market very narrow. Now, this has to reverse for the outcome that you are wishing for. Now, this can reverse with, let's say, good results. Results are advertisements by a business saying we are doing well. And our belief is markets follow earnings growth. Quarter two was good. Quarter three hopefully should be good. So that's a good start. Second is when the results are good, this should be followed by FPI buying. Domestics are buying. Domestics are there, but FPIs are not. So, and for FPI buying to happen, some normalcy in trade relations with the US maybe, would be a sentiment booster apart from results. And when this happens, I think HNIs, retail, which have really not done very well last year, would again, get hopeful, find hope, and come into the market, which would have trends. So last year was a period when very narrow part of the market performed and for short periods. So there was no trend which was there, which sustained even for 2, 3 months. So I think this is the route it has to end up taking for broader market rally as we get deeper into this new year. Now, there are a lot of uncertainties. We still don't have a trade deal, which is in some manner, keeping FPIs away. If it happens, when it happens, will it happen, are all unknown. So that is there. But then versus last year, offshore yields are lower. So yield-seeking guys should be ready to take more risk. We need currency to be stable, not volatile, any level to be stable. And then, entities like hedge funds who do levered trades would come in, and these guys are performance seekers. So we believe, the world believes in market follows earnings growth. So the faster growth spaces should end up leading performance once again. So I think that is the thesis.
Hmm. Uh, uh, Prateek, if I were to ask you, what direction does IT take? Where are we in terms of the cycle? And also, how does risk reward look? Would you prefer the larger caps, the mid caps, the small caps, or participate in none of them?
Yeah, so if the market continues to be index focused, like it was last year, in one part banks did very well, in another part IT services did very well. It can very well continue. However, if you look at long period trend of IT services performance, there was one trend which was there up to 2010, 12 to 20, sub 10% kind of growth, between 5 and 10% kind of earnings growth, let's say. And then there was a blip of 2 years when the growth accelerated to 15 and 20% for the larger IT companies. And now again, we are getting into the same range, 5 to 10% kind of expected growth, maybe helped a tad by rupee depreciation. Now, point is, if the growth falls to those levels, then why shouldn't valuations be in the same range as what you saw in, let's say, 10 to 20 period? If that is the thesis, then what you get from IT companies should be in the vicinity of the earnings growth that they register. And for the larger guys, it is sub 10%. For some mids and small, it is higher. So that is the construct, at least I have in the mind.
Right. Prateek, the other thing also is, are there pockets which have run up ahead of where the valuations should be? Is there anything frothy in the market currently that one needs to be wary of?
The Indian valuations are higher than world valuations. Okay, I would only suggest that don't look at, let's say, one sector valuation vis-a-vis itself and vis-a-vis some other space in the country, and look at some other sector's valuation in absolute terms, saying very expensive. Practically everything in this country is 1.5 to 2x the value that exists globally. So look at steel companies, look at cement companies, look at banks. Look at what we call value in this country and see what valuation they trade globally, and we will understand that our value picks are also probably 2x the valuation of peers globally. And in the same manner, what is supposedly growth and expensive in this country is also 2x the valuations that you see elsewhere in the world. In that context, this is where we are. Now, whether it is justified or can it be defended, to me, yes, because we are one country in the world which offers the possibility of a huge scale. Very few companies achieve it is another matter, but possibilities of a huge scale. We are the most populous country in the world, young, not so rich, very aspirational. So our best, let's say, have a very long runway of growth internally itself. Think of it, it's not available to a US corporation who very soon has to start to look at globe as their market. Okay. So if the longevity of growth is very high, very long, and the quantum of growth, we are the fastest growing large economy, is of an order higher than what you see elsewhere in the world. I think premium valuations can be sustained, especially in the context of a world which is deglobalizing, and each company basically better access to internal markets rather than global markets. So with that thought, I think where our valuations are defendable. In narrow pockets, yes, there can be fluff, but think in another manner. A lot of spaces have seen sharp price cuts over last 1 year, while numbers have kept on coming. Growth has been very strong. So let's say in a high growth space, stocks may be flat to down 20%, earnings may be up 30-40%, and that has resulted in very sharp cuts in valuations. So many of the so-called high growth spaces of 24 would also pop up on the screens of value investor today. Is the context of time. So lot going for the market, but you know, it's just a date change at the end of the day. So it can continue to be how it has been for last 3-4 months. Just because a date has changed, direction may not change. But just because how prices have moved, earnings have moved, a lot of the high growth spaces now offers quite a bit of value and should be appealing to value guys as well.
Understood. A lot of food for thought there, but Prateek, great to have you on the show. Thanks for your time as always.
Thank you.
Okay, let's revisit what the market has settled in at while it was